We're taking a look at why startups fail, and in this video we're going to take a look at what I've called post-investment external issues. So far we've looked at 8 issues which might become apparent during due diligence prior to an investment, but problems can arise at any time, and the next 3 issues focus on external factors which are likely probably only to surface after an investment has been made. The 3 factors we're going to look at are get out competed, product mistimed, and failed geographic expansion. So get out competed, what are we talking about? Well, it's a very competitive market out there, and you do need to keep an eye on what the competition is up to. Do not assume that first mover advantage is enough to win, because if you initiate a great product or service and you really create a very exciting market, you are going to attract in a horde of imitators who are going to compete with you, and you need to keep a very close eye on what they're up to. Now, if you're an angel investor or a VC, you've placed your bet, but that doesn't mean to say you stop watching the other players around the casino table. For the second one, product mistimed, we're looking at then what some of the issues that you can try to focus on to understand why this is the case and what you can do about it. It's possible that the technology that your product requires to go to market is not yet available. Are you dependent on other markets developing to be successful? Now, 2 examples of those are AI, artificial intelligence, and virtual reality, VR. Because if there isn't been enough take-up and you've got a VR headset or some sort of AI product, and there isn't enough of a developed market yet, you may be coming to the market too soon. Of course, ignoring user feedback can be fatal. You may be getting told that the product isn't ready, the product hasn't got the right features, or whatever it is. But the issue is, can the startup team recognize the issues in front of them? Do they have such tunnel vision on producing the product that they fail to see the obvious? Are they spending enough time talking to customers? This is something you can do as an angel investor or as a VC. You can actually take your time out and get specific customer feedback on the product that's being used. Another challenge is premature scaling, because the more a company grows, as they say, the further away from profitability it becomes. And what I mean by that is the cost base goes up when you're scaling ahead of the sales and the revenues and the cash flow coming in. And normally all the available cash is getting plowed back into even more growth. So you have the issue of scaling, hiring, funding, and growth, all of which become potentially problematic. And 70% of startups scale too early, and that can lead to critical problems in their growth pattern a little way down the road. So the whole point is that the goal of a startup is always not to be a startup. It's always to sort of move beyond that. But you can see when startups are potentially not ready by looking at a few key metrics and a few key red flags, if you like. Some of these are when the startup doesn't know the long-term value of a customer. This is probably because the customers haven't been around long enough, and that's an indication of maturity. If your business is not acquiring customers in a repeatable way, so you've got a very systematic low cost of customer acquisition, then you're probably not ready to scale. If you're spending more time in the business fixing stuff than on the business growing it, then you need to keep fixing it until it's ready. You may not have got your problem solution fit right. You may not know who your customer is and what you're solving for them. You may not have got your product market fit right, creating enough demand to scale into your market. And you may not have got your channel fit right, where your lower cost of customer acquisition and increased revenue will help you to reach profit. So if you're still struggling with any of these, then you're probably not ready to scale. Failed geographic expansion is an issue where one can easily make mistakes. Location has to be congruent with growth, and by that I mean if you've got a product which has done extremely well, say in New York, it doesn't guarantee it's going to get great take up in San Francisco or in London. And one of the proofs of the business is to identify whether the business can scale outside of its locality. If you've watched the Facebook film, The Social Network, you'll see that they started off at one university, and then they were seeing if they could get traction in other universities, and that was a geographic proof of scalability. Absolute classic case. Now, another issue may also be down to the fact that you're using remote teams. And these can be a real challenge in terms of teamwork, communication and cooperation. So the geographic issue may here be to do with where your people are located and how they're working together. So don't be blind to that. Now, in the next video, we're going to consider internal operational issues. So we've looked at some external issues which can affect the business, and now we're going to turn around and have a look and see, what can go wrong inside the business. And hopefully, if you can identify those issues, these might be things that you can fix. So this video has been about why startups fail. We've been looking at post-investment external issues which are not always in the control of the startup team.